Hey everyone, it's Brent from Wolf on Wall Street Trade with a market update for the week ending August 21st, 2020. This is a 5-minute chart of the S&P 500, and this level, 3386.15, was the February closing record high. So the S&P's been kind of just doing nothing for the last almost 2 weeks, really struggling. This isn't a big range. This is like a 1% range over here. So it did close above that twice this week to new record highs, once on the second lowest volume in SPY of the year. What you'll see in this video is two main themes. One, that it was a very, very mixed week. We had more S&P sectors closing down than closing up. And two, that reflationary or inflationary concern that was real dominant the week before, if you saw last weekend's video, that's pretty much just evaporated. We're going to take a look at the major averages on the week. This is a weekly chart, the S&P 500. This is that February closing high level right over here. So the S&P's been about 1% away from that for about 3 weeks. So it did manage to close above that this week. So up 0.7%. Wasn't a very big move. But if you look at the equal weighted index, and this is something we're going to touch on a little bit more. Here's the equal weighted index for the S&P 500. As you can see, it's nowhere near that February high. And on the week when the S&P was up 0.7%, the equal weighted index was down 1.5%, as you can see with this red candle. That's a pretty big divergence. So why? It's because there were a handful of stocks, you know them, they are the mega caps, Facebook, Amazon, Apple, Netflix, Google, Microsoft, that really drove trade this week. As such, the NASDAQ 100 made a new record high. It was the best performing by far on the week, up 3.5%. But again, if you strip out that weighting and just kind of look at what the average stock did, the equal weighted index of the NASDAQ 100 was up less than 1%. So about a 300 basis point difference between that and the NASDAQ. Here's the Dow. It was completely unchanged on the week, 0%. And you can see it's off that February high that the S&P took out. And small caps were the worst on the week. They were down 1.6%. So you can see last week, this is where that rotation to cyclicals value, that inflationary bias started. Last week, it was strong in the beginning of the week. It faded, so we got this weekly candle, kind of a stall. This is a bearish engulfing candle over here for this week. So worst performing, this is 2,000 some odd stocks as compared to 100 in the NASDAQ. The broadest index, the NYSE, down 0.7%. So pretty much the mirror opposite of the S&P 500, which was up 0.7%. But remember that the equal weighted S&P was down 1.5%. And here's the value line geometric index is well below that February record high, or just the 2020 record high. And it was down 2.5% on the week. So that means the median stock was down 2.5% on the week. So what a weird divergence. And it was all driven by mega caps. The mega caps were up between 2% and 8%. Apple was up the most at 8%. And you can see it's just going parabolic. So from this is the February high, so it's blown past that. But from the March low over here, Apple has added $1.1 trillion in market cap. And just on Friday alone, $100 billion in market cap. For some perspective, it's $2.1 trillion in market cap. It finally passed the 2 trillion mark this week. That is almost the equivalent of the entire UK FTSE index, the FTSE, which is valued at 2.2 trillion. So one stock. If we take a closer look on Friday alone, it was up over 5%. This is because the stock is going to split 4-for-1 on Monday, which does absolutely nothing to the value, but the argument is that people can afford the stock, and that's going to draw in traders from like Robinhood. They're going to be buying the stock at, $125 a share rather than $500. Apple alone right now, its weight is 14% of the NASDAQ 100, and it's about 6% of the S&P 500. If you take the 5 mega caps, Facebook, Amazon, Apple, Google, and Microsoft, their concentration compared to the S&P is the highest it's ever been. They're about 25% of the S&P 500. But what I'm going to show you is even in the NASDAQ, where these are tech stocks mostly, predominantly, even in the NASDAQ 100 this week, the actual breadth was horrible. So that's really one of the big themes this week, is really bad participation. This white line is an equal weighted index of Facebook, Amazon, Apple, Google, and Microsoft. Okay, so this week. You can see it soaring. In candlesticks here, that's the NASDAQ advanced decline line. This is the week So while NASDAQ was soaring on the week, up, 3.5%? The majority of stocks in the NASDAQ 100 alone were going the opposite direction. So the FANGs right here, you can see they dominated trade because of their weight. That's why the S&P is up 0.7%, but the equal weight index is down 1.5%, or the NASDAQ 100 is up 3.5%, but the equal weighted index is only up 1%, while the median stock is down 2.5% on the week. Now, the banks that touch every part of the U.S. economy, they are nowhere near that February high or the 2020 high. Okay, over 30% off of it, and they really got hammered this week. So last week they were up. That was that inflationary impulse with yields, all that. This week they got hammered. So this index of the bank index, the 22 biggest banks, down 6%. The regional banks were down even more than that, 7%. And this is why I'm saying that whole inflationary theme from last week just fell apart this week. Touching on small caps, IWM, real quick, this is that trend line I've been talking about from the 2009 low. The price broke below it. It kind of jumped above over the last couple of weeks as we got this rotation into value. And that was right here. We saw it fade last week, and this was the bearish engulfing candle. So this is that trend line right here. Here's a weekly chart of the Dow 30. Remember, 0% on the week, absolutely unchanged. We'll take a closer look over here. And you can see struggling really with resistance right at that trend line of that big broadening top for the Dow, well off of its February high. Talk about S&P sectors real quick. Out of 11, 5 were down, 3 were unchanged, and only 3 were up. The 3 that were up were technology. Okay, it was up 3.6%, but the semiconductors were down on the week. Consumer discretionary up 1.8 and communications 1.6. All of those are dominated by those 5 mega cap FANG stocks. The worst performing ones were the cyclicals that were trying to rotate in, like energy. That's a 10-minute chart, by the way. So there's energy rotating in on that value. Just completely retraced all of it, came down through a local support line over here. In major contrast to the tech sector's 3.6% gain, down 5.7% on the week. Same thing with financials, down 3.5% for the week. They pretty much completely retraced this inflationary rotation to cyclicals and value. You also had industrials were down, their cyclical sector, also utilities and materials. While we're on stocks, I'm just going to touch on Plug real quick. This was a long trade we're in, up 13% on the week. This is the daily chart. You can see just really bullish price action. Take a closer look on a 60-minute chart. So up 13.6 on the week, and you can see it still has bullish bias with this little flag. I would prefer that this was a bigger, stronger move up, and then we had this kind of bullish flag consolidation. But in any case, it still looks pretty good. I still have that higher target, and my biggest concern for this trade right now would be the broader market, actually, if the S&P starts turning down. Let's touch on that rotation dynamic, because that was a major, major change this week. Okay, so this is an intraday chart, and this depicts the Russell 1000 value and the Russell 1000 growth. This is where we had that rotation into value, and as that was happening, we saw the growth factor come down. So that's pretty much has been like the NASDAQ stocks, the mega caps and stuff have been considered growth. So they got hit. That completely reversed, as you can see, with value coming down and then growth moving up. That explains the whole mega cap bias this week. That actually started about the middle of last week. And the practical effect of that on this 15-minute chart, you can see, was that with value, small caps outperformed. And the NASDAQ 100 underperformed. Remember, about midweek last week, that started to change, and certainly a lot this week. So you can see that small caps, you can see how they underperformed this week very badly, and NASDAQ led the way. And by the way, this is highly, highly unusual. Typically, you will see differences in relative performance. One is a little bit better on the day, one's a little bit worse, but they tend to trend together. This kind of mirror opposite kind of reaction that we're seeing the last few weeks, this is just money going from one place to the other. Instead of money going in or out of the market, it's kind of like a coconut shell game, rotation. So you can see as a direct effect of money coming out of small caps, value, cyclicals, it's gone into NASDAQ 100, or more specifically, into those 5 stocks, and mostly Apple. Here we can visualize it on the week. So these are small caps over here in white, and the NASDAQ 100. They're normalized as of the beginning of the week, and you can see what I'm talking about. NASDAQ up, small caps down. S&P and Dow, well, here they are in orange and blue, pretty much in the middle. The Dow is completely unchanged. The S&P was up just a teeny bit. NASDAQ, small caps. Remember, the NASDAQ has the most exposure to those 5 stocks. S&P has exposure, Dow has exposure to 2 of them, small caps has no exposure whatsoever. And as I mentioned before, that means that the majority of the market really wasn't performing. So here's the NASDAQ 100 and here's the NASDAQ 100s, not the broad NASDAQ, but the NASDAQ 100 advanced decline line. This is the week NASDAQ 100 up because of the weight of those mega caps, while most of the stocks down. So that's really unusual to have it this bad in an index like that. And it was the same thing for the NYSE, which is a much broader index, the broadest. So here's the S&P 500, here's the NYSE's advanced decline line. S&P has been hanging around that 33.86 level. And you can see what's been happening while it's been doing that, trying to make that new high. The whole time, more and more and more stocks not participating, as you can see with the advanced decline line. Here's another look at the NASDAQ 100 and of the NASDAQ 100 component stocks, the actual stocks that make it up. This is the number of stocks, or the percentage of stocks that are trading above their 50-day moving average in white. You can see as we came into the year, January, February, it got worse. It was just those mega caps leading, and the majority of stocks weren't performing well. So since June, it has really been notable, this divergence over here. So this is fewer and fewer and fewer NASDAQ 100 stocks trading above their 50-day moving average. And if we take a really closer look just on this week, as the NASDAQ was up all week, the number or the percentage of NASDAQ stocks above their 50-day fell all week. So it wasn't just, bad breadth since June. This week specifically, horrible market breadth. And finally, I haven't posted this chart yet because it wasn't relevant until the S&P got up to this February high. So that's what happened this week. This is NYSE 52-week highs, and what should happen as the market rallies is you should see more and more stocks in the NYSE participating, making new 52-week highs, moving up like this. As you can see, as we came into January, February, that diverged. So we had that divergence right there. That preceded this crash. We have the same thing going on right now over here, but the bigger point is look at the S&P 500. It's basically at the same level it was back here in February. And just look at the difference. How many stocks are making new 52-week highs here and supporting the rally versus back over here? It is just horrible. So very, very weak market breadth, very weak market participation, just really being driven at this point, especially this past week, by 5 stocks. Okay, let's look at Treasury rates real quick. This is the last time we saw that really strong rotation into value, into cyclicals. This is really one of the strongest weeks I had seen because the bond market was kind of confirming it was moving up with that inflationary because of growth outlook, and then that changed real quick and fell back down. We've seen this kind of rotation at least 3 times in the last year to value into cyclicals, and it's failed every time, and we've seen it twice since June here. This was the second time. So this week, bonds did rally and the yields pulled back, but unlike S&P sectors where we saw energy, financials, banks retrace all of this reflationary or inflationary move, yields did not retrace all of it. But this could be another signal too of something else with the dollar that we'll talk about in a minute. With this, the long end outperforms, so the yield curve flattened. So this white line is just a proxy for the 2-year minus 30-year curve, and in the candlesticks is the banks. So this is the bank index down 6% on the week. You can see what happened. It followed the yield curve lower. Next, we're going to go to the U.S. dollar, and that is what I think is really interesting. My post that I did, weekend update, it wasn't a video. It was like 2 weeks ago. I put it up for free on the website. It talked about the potential for the dollar to rally. If the dollar rallies, a lot of people aren't expecting it, and it could have a really devastating effect across a lot of different asset classes. If we go back to the S&P on the week, 15-minute chart over here, if we go back on the week, it had this really nasty reaction to the FOMC minutes at 2 p.m. on Wednesday. So I didn't expect this to be a market-moving event at all. The market had a really negative reaction, basically saying the Fed is not dovish enough. So here's a daily chart of the U.S. dollar index. And since March over here, it has had an inverse relationship with stocks. So dollar down, stocks up. And what I mentioned a couple weeks ago was that right in this level, the U.S. dollar index was coming up to a trend line that was pretty important. That's been in place since 2011. And I thought, well, you know what? This is an area where we could see some support and potentially a dollar bounce, maybe even a short squeeze because a lot of shorts in this, right? This week, it dropped below that trend line right over here on Tuesday and then jumped right back up. That's a head fake or a false move. And the reason it jumped up was Wednesday, the FOMC. So the dollar itself had a very bearish reaction to the FOMC, or hawkish reaction, saying the Fed is not doing enough. So for a market that is just fueled by liquidity right now, it needs more and more and more and more from the Fed. And from the minutes, it didn't sound like it was getting it. So if we take a little closer look at these daily candles, that's a bullish engulfing candle on Wednesday as the minutes were released, and then again on Friday, another bullish engulfing candle. And if we look at a weekly, here's the destruction in the dollar since March, and that has benefited stocks. This is a bullish hammer. And one of the ways you can think about a hammer in Japanese candlestick vernacular is hammering out a bottom. And because the dollar has been getting killed ever since the market bottomed after that crash in March, everybody has just been just expecting the dollar to keep going lower. So it could catch a lot of traders offsides. Let me just illustrate how this relates to the S&P 500. There's 3 different relationships that the dollar can have with stocks. So those always change. It's not a constant. It depends on what's happening in the U.S. economy relative to other economies, what's happening with the U.S. central bank relative to others, where we are in the cycle, etc. But as we crashed over here, the dollar sailed over here. This was a flight to safety. This was a rush to cash. This was a dollar shortage. So since the Fed intervened with swap lines and everything else, their goal was to knock the dollar down. That's what's happened. And you can see the inverse relationship with the S&P traveling higher as the dollar has moved lower. That's why this could be a potentially important moment. Here it is on a 15-minute scale. So you can see dollar down, stocks up. And if I invert it real quick, you can see how tight this correlation is. So this is the dollar inverted and stocks traveling right along with that. If we take a closer look at what happened this week, and this is with the dollar inverted, you can see them traveling along pretty nicely. And here we come into the FOMC minutes. The dollar started to rally over here. Remember, it's inverted, and that preceded this sell-off in the market as those minutes came out right here at 2 p.m. And as you can see, on Friday, we had that bullish engulfing candle on the dollar daily chart. You could see it leading lower over here. So interesting. Let's go to gold. And here's GLD. I like to use it because I can draw the trend lines real easy. So you can see this is where, I thought we were going to have a consolidation. This is where I thought gold had just run too far. And it got shocked the prior week on those inflationary expectations. Real rates jumped really fast and gold fell. So since then, we've had kind of this bearish flag going on. Here you can see it. So it kind of slipped below, but it didn't just drop, the bottom fall out. So I would expect a little bit more downside in gold. But as you can see on this daily chart, I think the trend is well intact, the uptrend. I have no problem with it pulling back a little bit. It's got really a lot that it could pull back and still be in this massive uptrend. So I would like to see GBZ, gold's volatility, fall below 20. For that to happen, gold will have to correct, consolidate. Here's a 60-minute chart of SLV for silver. So silver added 1.25% on the week, not a big deal. And it's consolidating in this triangle over here. Here you can get a closer look. It may turn into something else. It may turn into a big flag or something, completely different. But at this point, that's what we have. Consolidations in gold, in silver, precious metals. Remember, if the dollar moves higher, whether it be a macro signal or whether it just be a short squeeze, that could have a dramatic effect on a lot of assets, and it could have a negative effect on gold and silver. I have long exposure to Bitcoin through GBTC, so let's just take a look at Bitcoin real quick. This is a weekly chart, and hopefully you can see at this 12,000 level right here. That's a key level, and it's just working through resistance right here at that 12,000 level, which you can see goes back to 2018. So that's fine. It's constructive. There's nothing wrong with that. Here's Bitcoin versus the U.S. dollar on a daily chart. We're getting a closer look at that 12,000 level. And so far, this is constructive price action. So we have a rally over here. Then we have a consolidation. It looks like kind of like an ascending triangle. So you have resistance right here around that 12,000 level. That's supply. You have buyers a little bit more aggressive each time price dips. You have volume rising on the rally and then pulling back on the consolidation. That's all very bullish. Here's a weekly chart of GBTC, which is what I'm long, Grayscale Bitcoin Trust. And like I said, weekly chart, this is that 2017 parabolic melt up that just got insane, right? Took a couple years to consolidate that gain, and you can see it in this big triangle. So there's the fractal nature of markets. We just saw a smaller triangle in silver, right? So this is a consolidation. It's a bullish consolidation because of the preceding uptrend. And on this weekly chart, you can see price has broken out, but it is coming up against that 12,000 level and working through that level of supply. On a daily chart, breakout above that big triangle, and this is what we have going on right now on a daily chart. Again, a bullish ascending triangle, much like what we see on Bitcoin. Speaking of bullish action, before we wrap this up, there's one I want to point out real quick. This is UNG for natural gas. You can see it's been getting just hammered since 2019, so just nothing bullish about that chart. But recently, it has shown some bullish activity. We're going to zoom in on this area right over here. And here we are on a 60-minute chart. So bullish flag. I wish I had seen this about a week or so ago. I probably would have gotten long UNG. And we'll see what this consolidation turns into. I have a higher measured move just from what happened over here, but I would like to see some kind of consolidation to offer an opportunity to get involved with better risk reward. So the main takeaways is we have a headline new high for the S&P, headline new high for the NASDAQ. Market breadth is horrible, which is why when you see these bigger indexes like NYSE, small caps, even the Dow or the geometric index, they're all well below that February level, which means the majority of stocks are not participating. And we've seen it, we're just used to those mega caps dominating the other indices. But the last week and a half, it's been extreme. So at the index level, they're covering a lot of sins that are going on with the majority of stocks that are just heading down. Like I showed you, the median stock last week, down 2.5%. That rotation to value, cyclical, the economy needs to improve for those kind of trades to work. And we've seen this just happen 3-4 times in the last year or so. Twice since June, people have this, optimism. They get involved in these stocks and it just doesn't work out. It doesn't last. Those are the stocks you would expect to lead out of a bear market into a new bull market cycle. That's typically what you see, and often you see yields leading them, yields moving higher first. None of that has happened in this whole scenario with the rally off that March low. We don't have a lot of evidence to suggest that the dollar is going to rally or just short squeeze, bounce, whatever it may be, but we do have a lot of evidence that it has a strong inverse correlation with stocks since March over here. So if it does, I think it could catch a lot of people off sides and by surprise. Just on Friday, I saw a report from Goldman Sachs that short interest in stocks is at the lowest that they've ever tracked. So going back 16 years. So there's no shorts left. They've been squeezed. We've seen that last couple of weeks, especially with that value rotation, huge short squeezes then and in June when it was tried back then too. But what's interesting is because, there's absolutely no shorts left, it seems like there's no hedging. If you look at the SKEW Index, this is a 50-day average of the SKEW just to take out some of the noise. What I'm seeing is major hedging in deep out of the money puts. That's typically footprints of professionals. It's at the highest level here since it's been really going all the way back to 2018 in October. This was right before the S&P sold off 20% October to December, and it's higher than it was right over here in February, and that's before the S&P fell over 35% in the market crash. So there is hedging by professionals. Thursday and Friday of last week, the SKEW Index or the Black Swan Index jumped up 9 points. So first on Thursday and then over here on Friday. This is nosebleed levels. This is like red alert levels. So this tells us that professionals are hedging their bidding up deep out of the money puts. The market is just getting very, very thin on very light volume. Market breadth is horrible. Next week, we do have Jerome Powell coming up. He'll be speaking at the Jackson Hole Symposium on August 27th. And as I already showed on this weekly chart, or actually it's a 15-minute chart of the week of the S&P 500, when the FOMC minutes came out at 2 p.m. on Wednesday, the market did not like it. And what was curious was there was nothing in there that hadn't been said before, but the market is looking for more accommodation from the Fed. and it didn't get that in the minutes, so it kind of had a little bit of a temper tantrum. And finally, the takeaway is while the S&P finally did make that new high, the majority of stocks went down this week and went down pretty badly, pretty ugly. So we'll leave it at that. I hope you enjoyed the video. If you did, please give it a thumbs up. Check out the website. I will leave a link to the website in the video description below, and you can follow me on Twitter. And everybody have a fantastic weekend. I will see members on Monday.